Recipes for technical trading success in Cook's Kitchen.
Who's afraid of higher interest rates? I'm shooting this Wednesday, a little after noon on June 13th, before the FOMC is about to announce a quarter-point interest rate increase and give their big outlook. It's the big economic shindig where they provide forecasts because it's June, and on the quarters we get the Jerome Powell press interview and economic projections and the dot plot, right? It's 95% sure they're going to raise a quarter point, especially since this morning we just got producer prices coming in hotter than expected. So the inflation data is creeping in. So I'm shooting this to tell you no matter what the market does, you want to buy it. Because if the market does pull back on the view of accelerated hikes, that we're going to get this one and maybe 2 more this year and 4 in the next year, then the market will probably sell off, but I think it'll be a buy. Okay, let's go over what we know. So here's the setup. The Fed is deemed by some to be falling behind the curve. From the May FOMC minutes, we got some new language about they're willing to let their inflation target get hot. In other words, it's okay if inflation, CPI, if their PCE measure goes to 2.5%. And the third thing, so, is it going to be, could there only be 3 hikes this year? So that's sort of the tension of the setup here, is that if large players are hoping that the Fed remains dovish and only indicates, hey, maybe only 1 more hike this year instead of, today and then 2 more, that could throw some investors off. Okay, let's look at the other points of the setup. I got Westbury, Brian Westbury of First Trust. I talk about him all the time, one of my favorite economists. He wrote a piece a few weeks ago called Why Not 50? Meaning he really thinks the Fed is going to fall behind the curve here as inflation picks up and growth picks up. He says, can't we just raise 50 basis points at one of these times? I don't think the Fed is ever going to do that. But the thing is the hotter the inflation numbers come in, it'll raise the probability that some large players think the Fed could actually go 50 basis points sometime, who knows? Maybe that's 6 months from now. Maybe that's, the first part of 2019. But, it's on the table. The hotter the inflation data gets, even if we don't think the Fed is going to do it, how do rates and stocks react? Okay. Inflation is creeping. We're seeing that. We're seeing it in wages. We're seeing it in a little bit in CPI, PPI now. 0.6 here. Flattening curve is creeping me out. Okay, I'm going to show you a chart of the yield curve, and it's flatter than it's ever been. The spread right now between 2-year notes and 10-year notes is down to 40 basis points, and we haven't seen that in a long time. So that flattening yield curve, lends market players to believe that, hey, when does it invert? Is the Fed going to raise rates, too fast? And meanwhile, what keeps the curve flat? Well, the world loves U.S. Treasuries, right? That's why, the 10-year or the 30-year aren't running away. Okay, so let's look at the yield curve. This is from Treasury.gov. A lot going on in this chart, but I wanted to pack it in. The green top lines are the current Treasury yield curve for June 12th, okay? And the blue line is a snapshot from January. So you can see how the curve has moved up, but it's also gotten flatter. So there I have your 210 spread. On top there, this month, 42 basis points. Back in January, it was 54 basis points. And the smaller curves down here, these are your real rates, right? So less inflation. But, we got to keep an eye on this. As this curve gets flatter, 40 basis points on the 210 spread, it unnerves some investors in bonds and stocks. Okay. Now I'm going to back up and give you sort of a long-term view of how we could look at this unfolding for the next 6 to 18 months instead of, while the market might freak out about the dot plot later today when we get that news. So, number one, normal takes time. We're getting back to normal rates. We're not there yet. So this is why smart investors can look at the Fed hiking 6 more times and not get afraid of it. Hey, Mav, can we go inverted? There is, so what is the harbinger of a recession? When the yield curve goes inverted. Why? Because the Fed is trying to, stave off inflation, and they basically create a recession by boosting short rates, to tamp down the animal spirits that are getting too hot. There is some talk among some economists that a yield curve can go inverted and not push us into recession. So there is that possibility. Just because there's this extremely high correlation of an inverted yield curve and a recession doesn't mean that they always go together. So I think we can look at the extremely flat yield curve as not a threat. Now, we're going to go back to Westbury. Westbury, basically, if I summed up his view, short rates will chase GDP to 3.5%. And as long as GDP is leading, then the Fed won't cause a recession. You should read Westbury. You should sign up for his weekly newsletter, FT Advisors. And his Monday morning outlook is always worth reading. Here's an excerpt from his Monday morning outlook where he's responding to, apparently Ben Bernanke has a prediction that in 2020 we're going to have a recession. Now, that's a little bit far out to just say, okay, I'm placing my recession bet here, when so much can happen between now and then. And what reason would he have? Is it an interest rate yield curve dynamic where he's saying, yeah, short rates are going to get above long rates and cause the recession? Here's what Westbury says. If the Fed were to raise the funds rate by 25 basis points 3 more times in 2018 and 4 times in 2019 to get us to 3.5%, and if nominal growth slowed to 3.5%, the Fed would be tight at that point, and a recession would be possible. So what he's saying is that, hey, GDP is tracking to keep unfolding here at 3.9%. So it's ahead, well ahead, and the Fed is slipping behind the curve. But it doesn't guarantee a recession. Okay, back to Westbury. And you should pause the slide and read this whole thing if you can. So he thinks that even a 3.5% Fed funds rate, which would be, we're at 175, so that's 7 more hikes, including today, right? Yeah, 7 more 25 basis point hikes, including today, gets us to 3.5%. He says it still wouldn't be restrictive. The Fed would have to raise rates faster and farther than any forecast we have seen in order to be tight going into 2020. At the same time, there are still at least $1.9 trillion in excess bank reserves. Until those reserves are eliminated, no one knows if raising rates can actually cause a recession. So he does highlight one worry, and that's government deficit spending. That can create its own dynamic. But the main idea here is that the Fed already told us they're going to let the economy get hot. So I don't think we have anything to fear from the Fed's economic projections today, unless unless there's a couple of dissenters that say, hey, we should have raised 50 basis points today and we should do it again next time, which I don't think there's going to be. That would be the only thing that would change this positive, very positive interest rate outlook for the economy and the stock market. So buy this dip. Oh, I got to show you my last slide. Let's game the scenarios. Here are my scenarios. After today's Fed announcement, market sells off 1 to 2% into Thursday. That's my base case. That's my 65% chance scenario. My number 2 and 3 smaller scenarios are, let's say market takes a really big hit, doesn't like something in the projections or the dot plots, and we sell off 3 to 6% in the next week. I only see a 15% chance of that. I think it's much more likely that we could actually rally on a stable Fed outlook. So I gave that a 20% chance. So that's how we're gaming the Fed. You're likely going to watch this after the news is already out, but hopefully this will give you some guidance about how to interpret what the Fed said and how the market's reacting. All right, thanks for joining me in the kitchen.